Welcome to another exciting edition of the Trading Bell. This week on the program, we speak to the Group Managing Director of Equity Bank, and this is Dr. James Mwangi, and we'll be discussing a host of issues from the bank's future outlook, as well as how is the bank coping in a COVID environment, and also, is it time for us to see further cheaper interest rates? And what is the bank doing when it comes to spreading its wings across Africa? All this coming up on the show, but let's begin with a quick look at his profile.
Dr. Mwangi is a celebrated African entrepreneur and named by the Financial Times as one of the top 50 thought leaders in emerging markets and among the top 20 most influential people in Africa. He is a career banker with a bias in inclusive finance. He's a certified retail banker and was admitted to the honorary membership of the International Academy of Retail Banking. He's a Group Managing Director and Chief Executive of Equity Group Holdings. Dr. Mwangi is credited with providing the innovative leadership that has seen Equity Bank transform from a small and technically insolvent building society to one of the largest and most successful digital and inclusive banks in the world. Equity Bank has become the first bank to go fully digital across 6 countries where the bank operates. Dr. Mwangi is also the founding executive chairman of Equity Group Foundation, the social impact investment arm of Equity Group.
Thank you so much, Daktari, for hosting us at your offices. Such an honor to have you on the program.
Thank you very much, Abby, for the privilege.
And Dr. Mwangi, you are literally one of the men who have been very consistent in terms of pushing the financial inclusion agenda, not only in Kenya, not only in East Africa, but across the globe. As we come out of a pandemic, perhaps, are we likely to see banks getting into a better fiscal environment when it comes to their trading results?
Thank you very much, Abby. Over the last 2 years, we've gone through a very challenging time. The responsibilities of the banks was to protect the businesses of their clients. It was to ensure their clients' businesses survived. Businesses were able to look after their employees and the households that owned them. Now that COVID is coming to an end, it's time for us now to relook at recovery. How quickly can we recover? But more importantly, how much resilience can we build in our businesses, in our economies, so that future shocks do not cripple us the way COVID has crippled us. So the jobs of the banks is well cut. It's all about recovery. It's about building back better. It's about resilience, and then growth and thriving of the economy, so that again we can get back to our lives, we can continue to build our lives, and we can seek better days into the future.
Interesting. And you bring up a very important aspect that I'd like us to delve deeper into. We are in a position and space in time where majority of Kenyans are still sagging under the high cost of living. Businesses are struggling to get back on their feet. Banks have also been a big player when it comes to being intermediaries. And from where you sit, how are banks adapting in this environment in terms of giving businesses hope as well as injecting new capital?
COVID started as a health crisis, but quickly transformed into a humanitarian crisis, a social crisis, heading up as an economic crisis, disrupting everything the world had built. And that is the starting point for the banks. And banks has a very huge responsibility of financing, building the world back better, helping businesses that were crippled to recover. So it means refinancing. And in some instances, it's starting all over again, retooling, repurposing businesses, because a lot of changes have come through. If there is one thing we can credit COVID with, is transforming the world in the shortest period in history. The world has embraced digitization, and digitization is a different way of doing business. Businesses have become online, businesses have become virtual. Essentially, we have lost the technology that brought us this far. We have lost the models that brought us this far, and we have to embrace new business models that are aligned to online businesses that are virtual in nature, where the issue of mobility of human beings has been limited. So that whole concept of building back better means massive financing by the banks. COVID has eroded the capital basis of the banks. It impaired the capital building machinery of banks through profitability. So shareholders, as you said, have had to make sacrifices. Yeah. For 2 years, the shareholders of Equity Bank couldn't get any dividend. They had to pump in an additional 20 billion shillings in a foregone dividend. Mm-hmm. So those are the sacrifices that shareholders had to do to build up capital. But that was not enough. Equity had to go to the market and get nearly 50 billion shillings in long-term debt that complements capital. Tier 2 debt of 30 billion shillings, because the risk profile of banking had increased significantly. And the only way to mitigate risk is raising capital. It's the buffer that mitigates risk in the financial sector.
All right. And speaking about the state of banks in the country, Equity, you crossed the 1 trillion mark when you look at the size of your balance sheet. And this is not very common in this side of the Sahara, seeing banks that have literally grown from grass to grace. And is this going to translate into a bigger fund for small businesses? Because as we speak, businesses are still underserved when you look at the uptake of loans.
Abby, it's true that during the COVID 2 years, Equity balance sheet expanded from 600 billion shillings to a total of 1.3 trillion. So it more than doubled the size during that period. And we can debate about why, but research has said that Equity was a big beneficiary of trust capital. Mm-hmm. It was trusted, and it acted in a very responsible way, particularly in providing government hospitals and mission hospitals with the PPEs. And that won the hearts and minds of Kenyans, and they consolidated their banking into Equity. We launched the recovery and resilient plan to fund the private sector, the businesses, with up to $6 billion US, or 687 billion Kenya shillings. This stimulus is what governments do, but this time is to the private sector. It's not government spending, it's the private sector spending. And we are hoping that for every million shilling that small and medium enterprises spend, we're seeing they're able to build or to create 5 jobs directly and another 5 jobs indirectly. And that is why we said, if we funded small, micro, and medium enterprises, up to 5 million of them, and give them these 700 billion shillings, we believe they can create 50 million jobs within a period of 5 years.
And this puts the bank at a very interesting position, Dr. Mwangi. And from where you sit, there have been concerns around the cost of credit. Is this going to perhaps tilt the tables when you look at affordable credit?
It is true interest rates have acted as a barrier. But truly, when you look at it, the bulk of financing in this country is from, at the moment, from digital lenders. But the digital lenders are almost lending at 100% interest rate annualized. Mm-hmm. So when we come with interest rates of 13, then it can only be an excuse. But I'm glad that the central bank governor of Kenya has provided leadership to where we can think more about the people. We're saying people have lost 2 years. Last year has not made the situation any better. So we have felt that we need to come out responsibly as a market leader and try to influence the direction of interest rates. And so working together with the central bank, we have arrived at a risk-based interest method of determining interest rates. So we can say agriculture, this is the leader risk that we need to price. Manufacturing, this is payrolls, this is the risk we need to do. Micro and small. And then we have tried to make it very simple and said, let's not have loan appraisal fee, let's have all these, let's have one interest rate that is annualized and reducing balance method of computation, so that you only pay for the number of days you are holding the bank's money, not annually. Raise sometimes when you are charged 2 and you borrow for 7 days, it means then you have paid 304% interest rate.
Yeah.
But if then you take for 7 days, we only charge you interest for those 7 days. So that method will simplify. It will make credit much more accessible, so that our people have no excuse of why not borrow and fulfill their dreams. Nobody should ever die with a dream that was never realized. Banking has made, or equity, let me talk up for equity. Equity has made money affordable.
All right. Daktari, do you envision a time where Kenyans might be able to borrow at a single-digit interest rate?
We're almost there, because essentially for the last 5 years, interest rates have been capped at 13% effective interest rates. So essentially, we are around single digit. And if you look at the way we have really computed, and when we add all these together, we are now coming to the lower teens. And when you take about the lower teens, the weighted average interest rate for equity has been 9. So it's a single digit number. So it is that mix that, but let me remind Kenyans, interest rates don't start on their own. The base of interest rate is the sovereign risk rate. At what rate would the Kenya government borrow money? If you look at treasury bonds of 5 years, the government is borrowing at 12. And that's where rate Kenyans are borrowing. If you look at Kenya, inflation is at 7. So when you remove 7 from 13, the real effective interest rate, is 13 minus 7. Yet, you pay the depositor 7%. So it is not as easy as Kenyans would say that this is it. Interest rates are a market rate. There are 3 rates. There is inflation, there is interest rate, and exchange rate. Banks have no say on the interest rates. It's an economic price.
Yes.
So it's like inflation. They are price takers. So it is doing the best we can do given the state of our economy and the circumstances and situation of our microeconomic environment.
Awesome. Thanks for refreshing my economics, Daktari. And I'd like us to talk about the state of politics and the impact this can have in an economy of our size. We are just a few months away to another election, which has been tipped to be a 2-horse race. And in every election year, we've been seeing GDP numbers tanking. What do you see in your crystal ball this time around?
There are 3 things that are acting or forces in play. The first one is enlightenment. Kenya government gave free primary education in 2003, and then on made day secondary education free. Our people over that period has really gone to school. The biggest driver of change is knowledge. The Bible says, my people perish because of lack of knowledge. With Kenyans acquiring knowledge and insights and wisdom from distilling all that information they get to school. They are becoming more enlightened. That's one thing. So it's a more enlightened Kenyans that we are dealing with than ever before. The second one is evolution. Since we formulated and implemented the governance structure under the Vision 2030, enacted the new constitution, we have seen institutions have come into being. The governance institutions, and particularly the Electoral Commission and the judicial system and the parliamentary system, they have been tested. I think the fears that as Kenyans we held, that we had not developed our institutions, they had not come of age, that is no longer true. We have institutions that can guarantee us that the right things will really happen. And lastly, is that we are coming from a period that we have lost 2 years during the COVID period. So as Kenyans and people, I believe, will act in our best interest and ensure we have a smooth democratic election that allow us to move on, that allow us to exercise our right of voting and determining who manages our country. So I'm very optimistic that we'll behave responsibly. And if we behave responsibly, we'll get responsible good results, and that we'll move on. And that elections will now become part of our cycle of life, but not a driver of the quality of our lives. Lastly is that the Kenyan economy, the private sector, have become fairly significant. A bank like Equity today constitutes 13% of the entire GDP of the country. With that kind of players in the private sector, it means that we have now two sets of forces in the marketplace, the public sector and the private sector. I hope the private sector will behave responsibly to ensure that it supports the public sector for an orderly election.
Interesting. And Dr. Mwangi, you've raised a pertinent issue, citing that you're quite optimistic. And over and above that, as we look forward to the elections, we also have the national budget, which is coming up in the month of April. And the Treasury is literally putting to us the final budget under President Kenyatta's administration. And this has been a very interesting transition, looking at the big four projects at the same time. Which areas do you think will be forming a big area of priority, especially now that countries are slowly coming out of a pandemic that had devastating effects?
I believe the government, acting responsibly, will spend more of its budget to try and stimulate the economy. It is turning the wheels of the economy. It's giving incentives for investors. I believe the budget will now be about optimal utilization of the infrastructure we built, the SGR, the energy generation, the roads. How can we use them to make Kenya a low-cost destination, because we have the infrastructure? How can we use the infrastructure as an enablement for the private sector to build a bigger economy? To me, that's where the budget will go. Of course, there will be a portion to complete the projects that have been started and have not been completed. But I will also appeal to the government to look at what it owes the private sector and budget to have trillion shillings in outstanding bills to debts to the private sector. If that is pushed to the private sector would perform much, much better, because it will have the cash flow that allows it to build. The private sector has one window of opportunity. The global supply chains are broken. We can do what we did with PPEs. When Equity donated 1.1 billion shillings for PPEs, it chose not to import. We chose to support 76 factories to manufacture them. We ended up having jobs. We ended up being exporters of PPEs. We ended up building wealth and job opportunities in Kenya. That is the opportunity the Kenya private sector has of broken global supply chain, replacing them with local and regional supply chains. And that would stimulate our economy significantly.
All right. And as we wrap it up, Daktari, for the ordinary mwananchi just watching and listening to you, and you've painted a rosy picture that we'll see a very optimistic outlook for the year. At the same time, what is your message to which areas are you seeing going to open up, even as things continue to stabilize, that people should consider tapping into other than the global supply chains?
I believe we could be a better society if we could really prioritize our national value system. How do we behave as a nation? How do we treat the weakest among us? That, to me, would help us create reflections of that would help us build a national value system that could give us a better society. The second thing is to look at every Kenyan straight into the eyes and say, in each of us lies the power of one. Collectively, that individual power can shape the destiny of our nation. For the sake of our country, for the sake of our children, let's be the best of ourselves. And being the best of ourselves, collectively, Kenya will be a better country for our children. Lastly, nothing has ever been achieved without effort and hard work. When we got independence, we said if we go back to the rural areas, it's go to work. I think we were called on to give our best. Nothing will happen to Kenya unless we make it happen. Each of us can play a role in what we are best. I'm glad that you have asked me this question when we at Equity has put Kenya into the global map by giving it the 5th best rated finance brand on earth. That is what each of us should do. Make the best, and then collectively we'll make the Kenya the best, and it will be a better home for our children.
Amazing. Always a pleasure speaking to you and listening to you, sir.
Thank you, Abby, for the opportunity to converse with you.
Asante sana. Well, you've heard it from the Chief Executive of the Equity Group, that is Dr. James Mwangi, who leaves us with a very interesting quote saying that nothing has ever been achieved without effort and hard work. And he paints a very optimistic outlook for 2022, even as the country stares at another election. Well, that's why we wrap it up on this week's edition of The Trading Bell. On behalf of the entire team, we say bye-bye for now, keep it safe, and remember, we all have a responsibility as citizens.
Profit before tax, a growth of 134%, with profit growing from 22.2 million to 51.9%. After tax, net profit has grown from 20.1 billion to 40.1 billion, a growth of 99%, moving from 1 trillion shillings to 1.3 trillion shillings in a span of a year. 300 billion shillings balance sheet growth. Customer deposits have increased from 740 billion to 959 billion, a growth of 29%. The expansion of deposit, driving the growth of the balance sheet, has made Equity emerge the largest bank in Kenya and the largest bank in the region in all respects: balance sheet, profitability, market capitalization, and customer base. NPLs, non-performing loan book, from 11% to 8.3%, with an increase of provision coverage from 89% to 98%, a 98% growth in earnings per share to 10.4 shillings per share, up from 5.2 shillings, the board has recommended a record dividend payout of 11.3 billion shillings, a 50% increase from the last dividend payout for 2018. Equity Group is well positioned for the future, and Equity has chosen to remain focused to its true north, irrespective of circumstances and operating environment. The policy breaks the decision or not the environment.